How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This video is mainly going to be my TDA, my top-down analysis on moving into a new month. So I speculated that I like to pick AU for the next coming months. Now, why did I pick AU? I simply picked AU because it had a small range candle for the month of March. Larry Williams has taught in his book that small range candles are normally followed by large range candles. And we can see that is true. You can see there's a small range candle. Look what happens the next month, large. After a large one, it jumps back into a small, small, large. So I like to see that March was a small range candle. After that, I move it forward. I like to look at now the seasonal charts. So I look at the seasonal charts and I see for April, it is showing signs of tendencies going up in April, which is a good sign compared to the US dollar. So we're doing an intermarket analysis. We're comparing a counterparty here. And we know the dollar's inversely to the euro or Aussie or British pound or New Zealand dollar. You can see it's going down. When we check the other family members, we can see as well, April is going up for British pound. For euro, it's going up as well. For New Zealand dollar, it is going up as well. So we have a good sign that the foreign currencies, anything that's against the dollar, is bullish. And dollar should be suggesting signs of lower price action for April. After that, I like to look at the chart and like to see what is occurring currently on the monthly chart. So if I were to look back at what we have currently in price action here, I want to see what has been broken. Well, I can currently see a swing high here has been broken. And that to me could be signs of bullish momentum. So I like to alert that. I point that out to myself. This could be a possible sign of bullish momentum. It could also be a false break. And as you can see here, just as an example, see how price takes out this swing high and then runs lower. There wasn't a higher swing low after breaking this swing high. That's a false break. Instead, after breaking this swing high, we get a lower swing high and it continues to trend lower. So here we're back at that same stage of breaking a swing high. After breaking a swing high, if it is truly going to be bullish, I would like to see a higher swing low form. So the next candle, if it's going to be bullish, should not come down and break this low point because that's our pending swing low that's going to form. So I'm anticipating this to possibly be the swing low if I'm taking the bullish bias or bullish stance. This as well, we have a PD array. We could see we just recently trade down into a fair value gap or busy. So a buy side imbalance, a sell side inefficiency. So the market was inefficient in filling the sell side because it was buying so quick on the way up. We also have a balanced price range. So you have a fair value gap here. That also has a fair value gap here as well. And this is the smaller range here. I'm not too fond of using BPRs, but I can see that this range here has been filled in with a fair value gap to the downside and another fair value gap to the upside. So this range looks to be very solidified and well balanced. Price came back down into that fair value gap or busy, and now it could be looking to trend higher, creating the swing low formation in this fair value gap. I can also see we have a swing low here. And if this is going to be where the commercial started buying, essentially, this would be another position for them for retracement and getting into net longs once again to push price higher to potentially take out this recent swing high here that it created. That's what price would probably most likely aim for. We can also see prior here, we have a swing low that's all the way down here. This swing low is lower than this one. So that's a good sign that we're probably still in a bullish trend. Now, if we get a higher swing low, that gives me even more confirmation that price action may run higher. So that in the near future, it could probably take out this swing high here. This swing high up here. And this swing high up here. Now, that's not to say it would happen in 2 months or 1 month. But long-term perspective, if I'm being a buyer on the monthly chart, that's what I would aim for, these swing highs. There's also one here, but I don't have to mark out every single swing high. But there's buy-side liquidity above all these highs. And then moving forward, what I do is I would then try to break down IPTA. So I'm going to come down, I'm going to open up my IPTA template, and I'm just going to see what levels do I have going into the month of April. So we're going to be looking at Aussie USD. I'm going to come down to the daily chart. And right away, I'm going to start marking off. Though we don't have the opening price for the month yet, which we will shortly in a couple hours, I'm going to look back 20 days. I need this tool. It's 20 bars here. And within this 20 range period, I'm going to look for my highest high. And I can see that highest high is going to be here. And then I'm going to look for the lowest low that we have as well. I'm going to make this high red. And then I'm going to look back 40 days from the official trading day of the new month. And I'll do the same thing here. I'm looking for the lowest low, which is here. And then I'm going to be looking for the highest high as well. And I'm just going to repeat the same thing for this 60-day look back period as well. So I'm coming back to the official trading day of the month, the first official trading day. I'm going to go here. And then I'm going to find the highest high and lowest low. Fan on my computer got so loud. And then I'm going to cast forward 20 bars. So I know that's my time that I'm expecting a new liquidity pool to be ran. I just want to keep myself organized and neat. The cleaner the chart, the clearer you're going to see the price action. That's just my analogy. So if I'm going to be a market maker and I want to be bullish, I would most likely open price here, bring price below the monthly open, maybe even run a swing low. So this swing low here, or even this one here, or even possibly the 20-day low itself. There are times where it doesn't run the 20-day low. So price can open, fake everyone out, go short, take out these equal relative lows here, even possibly run out the 20-day low, which is most likely preferred, create a swing low formation here, then run higher, then create a higher swing low, higher swing low, higher swing low, aiming for buy side liquidity above the swing high. So that's a general rule of thumb that I'm using going in to the new month. So after that, I'm also now going to take this chart and then break it down onto the monthly chart and see where these levels line up. So looking at the monthly chart, we can see that 20-day look back low is the actual anticipated swing low formation that may be forming on the monthly that's trading into that fair value gap here. So if this low is ran one more time, then I would look to probably go long. If this low is ran, then that means the swing low formation is going to happen a little lower. This isn't where the commercials really want to get another long position. They're going to still further drop it lower because they're still looking to put a larger position on, and then they probably make a higher swing low without taking out this swing low, and then price should continue to run higher. I can also see that 60-day look back high is the swing high that we have here, so I like the way that's playing out as well. So if price was bullish, it comes down, takes out a low, then ranks up higher, taking out the 60-day high. Then I'm going to break this down on the weekly chart. So I'm still looking at the IPDA levels, but I'm looking at it on the weekly chart. I'm looking to see if we have any swing highs that are recently about to form in price action. I can see here we have a swing high formation, 1, 2, 3. It's not confirmed because the low point isn't broken, but in theory it is still a swing high formation because there's a lower high on the left and a lower high on the right. If the next weekly candle trades down and then runs up, or just runs up in general and breaks this swing high, I would look on the weekly chart. I would anticipate in the next week or the following week that most likely we get some type of swing low, higher swing low formation above this. So something higher than this after breaking this swing high here. That would put me on alert for bullish price action or bullish momentum. That's how I would justify myself going long for April. But I know overall, if the commercials are going to go long, they're going to open price and bring retail traders on the wrong side. That's the crucial step. I know that at one point in time, at the beginning days, or even the beginning weeks of a month, the first 2 weeks or the first week, there's probably going to be a Judas swing or a fake move to get people on the wrong side. As we can see, it's supposed to be going up. And if it's overall going up, it's first going to go down, then up. Same thing for US dollar. It should be inverse. If it's going down, odds are it's going to give a fake move up, then go down above April's monthly opening price and then go down. And then we should see a lower swing highs form and lower swing lows form. If you're in a bullish trend, you're going to see higher swing highs and higher swing lows. If you're in a bearish trend, you're going to see lower swing highs and lower swing lows. They always work in tandem. They don't work opposite. They move together. After that, I like to break down some COT information. So I come onto barchart.com and I come down to the asset that I'm looking for. So I'm looking for Aussie dollar. Once I come here, I'm on the futures contract. I'm looking for the highest contract with the highest open interest. You can see the highest open interest is June 2023 right here. I can see it's already selected for me, but I'll just click it just for reference sake so people don't flip out. So I click it. After that, I come up here and I click interactive chart. So it's not like trading view, but I'm able to now interact with an actual chart and use it. At this point, I'll let it load. Here, what I do is I take the volume indicator off. Don't need that. I instantly put it on the COT indicator. So we have 3 speculators in the marketplace: small spec, large spec, and commercial spec. I don't care what they're doing. I don't care what they're doing. I'm mainly concerned about what the commercials are doing because they're the ones that actually control price and they're the liquidity providers. Then I change it from bars to open close candle. I make this larger and everything should transfer over onto the larger page. And at this point, I look back a year according to this net zero line. So the way people use this indicator is the average person uses this indicator by using the net zero line. The net zero line is supposed to represent either net long or net short. So when you see that red line, the tracking of the commercials buy or sell orders above it, that should tell you bullish or buying, that the commercials are buying. If it's below it, that's supposed to tell you that the commercials are either selling or it's bearish. You can see currently price is above the net zero line. However, we can't truly go off of this because we know the public eye is fooled by this indicator. However, ICT has exposed traders, so another way to use it and utilize it. You take the last year highest net long position and the highest net short position. So I know it's not like TradingView. You don't have a magnet to actually get it perfectly on the net high and net short position that you want it to be on, but you can average it. And at that point, we're going to cut that range in half. So we're taking the largest net long and the largest net short, and we're cutting it in half. So it's 44.71, 71, 711, I think. I'm not sure. Totally forgot. It's 741. 441. There we go. So now I take the fib off, and now this new line is going to act just like this net zero line. We can see, even with the price action in itself, look at how price is above the net zero line here, which would indicate buying. But how come the price action is going down here? Because we know there's a hedge program that the commercials use. They could be in a buy program but hedging, and they're going short. They're going hard against their buy positions or their buy model. And the same thing vice versa. This net zero line, or the red line here, the commercials tracking line here, could be below zero, which would indicate selling, but then in the price action, it's going up. However, ICT has exposed people to see when you create a new net zero line, taking the highest net long and the highest net short within the last year, you use this and you can see the hedge program. You can see how it's above zero, but this line here, You can see the price action, the red line, is below the new net zero line in blue. Look at how the price action drops as well with it. You can see here, price is above. Now when price gets above the new net zero line and they're above zero, that's most likely signs of them buying. Extreme buying is occurring. Whenever you see it below, most likely you might be met with a hedge program and a selling opportunity. You can see how the commercials are below here, but above zero, and the price action reflects the hedge. There goes the hedge. And then we have these lower swing high opportunities. If this is the leg, if this is the sell side down, and now we're going to get the buy side leg up, we're going to most likely aim for the swing highs or the short-term rallies, and then fails. So the fail breakouts, drop down, fail breakout, drop down, fail breakout, drop down, that most likely will be traded into on the buy side going up. So that's how I like to speculate price action from top-down analysis generally. The process is pretty simple. I don't try to overcomplicate it. I've been doing it enough to make sure that I have a very concerned filter, and I'm not trying to pull myself in every different directions. I can sit here and look at all time frames, daily, weekly, monthly, 4 hour, 1 hour. It gets too complex at one point in time. You just want to be able to say, am I bullish or am I bearish, or am I sitting on the sidelines? The quicker you can come to that, the quicker you could probably get into the markets, and the easier it is for you to catch trending moves. Or the easier it is for you to say, okay, I'm not actually going to buy anymore because it's going against what I thought was going to happen. I'm going to go short. Or vice versa. Oh, I thought it was going short, but I could see the price action is showing me it's actually making higher highs and higher swing lows. Let me go long. So this is normally my TDA breakdown. So I'm coming off of the price action in itself from the monthly chart. I'm coming off of IPTA based off the daily chart, and then looking at it on the weekly and monthly. Then I'm also looking at the seasonality here. And then I'm comparing its cousins or brothers or sisters and seeing if it's doing the same thing. If Aussie's going up, odds are British pound is going up, euro is going up, New Zealand dollar is going up, and even probably CAD and other pairs as well that are inverse to the world reserve currency. Dollar should then be going down. You can see that. So I'm utilizing certain times or certain months where it's most likely going to be favorable for me to find a buy setup in Australian dollar, right? And if we could see dollars going down, then we would like to look at pairs like maybe UCAD, U-Swissy, and is CAD on its seasonal chart going up or down? If DXY is going down, I would look at CAD's seasonal chart to see it going up. Or I would look at Swiss franc's seasonal chart to see it's going up as well. And that's normally how I do it. Then I come down to bar chart. I use the futures contract and I use the COT database here as well. Now I know some people will come here and say, oh, they use the commitment of traders. So CFCT data. People will come down here, and this is how you would find it. If I could reload it. You'll come here. Once you get to this website, you go to Chicago Mercantile Exchange, you click short format. You have everything that you want. If anybody tells you have to pay for this information, they're lying because it's publicly put out for the public. You can see you have butter, milk, lean hogs, live cattle, lumber, feeder cattle, whey, cheese, Canadian dollar, Swiss franc, Mexican peso, British pound, Japanese yen, Euro FX, Euro versus pound FX rate, Brazilian, New Zealand dollar. Where's Aussie at? Bitcoin, micro Bitcoin. Yep, you even have the minis too. S&P minis. And I know Euro, or Aussie, I mean, is somewhere. Oh, there it is. And you can look at this. We're only concerned about this category here. So you can see the recent date. So it is lagging. The COT data is lagging. I want people to know that. Commercials information is the only one that we're paying attention to. Long and shorts, what you do is you take these two numbers and you subtract them. You don't put the larger number in front. So if this was 83,000, don't put it in front because you want to put the larger number in front. Just do it as it is, long minus shorts. If you take these two numbers and you minus it together and it's positive, odds are the commercials are probably buying. That's how I would use this data here. But this alone does not give us the hedge program. You have to go down into the bar chart information and break down this to understand the hedge program. So all in all, hopefully this video was insightful to you. This is my top-down analysis.